An elimination period in a long-term care insurance policy is the waiting period or number of days that you're considered benefit eligible and typically receiving care, but before you start to receive payment for services. Think of an elimination period like your deductible on your car insurance, except it's measured in time rather than a dollar amount. During this time, you must self-fund your care costs before benefits can begin. Your elimination period is determined at the time you purchased your policy. This waiting period could be 0 days up to 365 days. The most common elimination period, though, is 90 days, although some carriers have a 0-day elimination period for home care with 90 days for facility care. What does benefit eligible mean? Tax qualified policies sold since 1997 will require specific benefit triggers for benefits to be paid out. There are 2 ways to be benefit eligible in a tax qualified policy. Number 1, a physical impairment where you need substantial assistance with at least 2 out of the 6 activities of daily living. These are transferring, toileting, bathing, dressing, eating, and continence. Or number 2, a cognitive impairment like Alzheimer's where you need substantial supervision. There are 2 main ways that companies measure an elimination period. Number 1, calendar days, or number 2, service days. A calendar day method is the most desirable but the least common. There are 2 specific ways a company may count the calendar days. The first is the elimination period clock starts after you've met the benefit triggers and are considered benefit eligible and after the first day of service has started. The second way the elimination period clock starts after you've met the benefit triggers and are considered benefit eligible. Using this method, the elimination period starts even before long-term care services have begun. Using a calendar day method, if you only receive care 2 days a week, the full 7 days of the week still count towards that elimination period. It's important to know cash indemnity policies usually use a calendar day elimination period. You can use a professional caregiver or family member during the elimination period. However, a professional caregiver during the elimination period will likely properly document care more effectively than an informal caregiver. The second way an elimination period is measured is using the service day method, and this is the most common. The elimination period clock starts after you've met the benefit triggers and received the first day of approved professional long-term care services. Only the days that you pay for services covered by the policy count towards the elimination period. If you receive care from a family member or informal caregiver, that does not count toward meeting your elimination period. If you receive care services just 2 days per week, it will take longer to fulfill your elimination period than if you receive services 5 days per week. If you choose a policy that has service days, just make sure you understand it will take you longer to receive benefits if you aren't receiving benefits every day. There are also 2 variations that an insurance company may use to count the elimination period: service days with credit and 0-day elimination period for home care. The service days with credit requires you to receive professional long-term care services like a typical service day, but this will give you a full week's credit of 7 days even if you only have 1 day of care. The 0-day elimination period for home care simply means that there's no waiting period and you can receive benefits day 1 if you're benefit eligible. Make sure you file your claim as soon as you're benefit eligible so that elimination period clock starts. If you can customize your elimination period, generally a shorter elimination period will have a higher premium and a longer elimination period will have a lower premium. Think about what you can afford to pay out of pocket during that time. Not all policies allow you to customize the elimination period, but the most common is 90 days. The bottom line, make sure you know how your policy calculates an elimination period using a calendar day or service day method, and if they require you to meet the elimination period just once in your lifetime or for each episode of care. Most companies require you to just meet the elimination period 1 time during the life of the policy. In both the calendar and service day methods, you'll need to self-fund your care costs during that elimination period before benefits begin. Understanding what type of elimination period you have will help you be prepared at claim time. I'm Kelly Augsperger, certified long-term care insurance specialist with Steadfast Insurance. If you have any questions or want to learn more, connect with me online or give me a call, and I'm happy to help.